Hello each and everyone, the one who is watching my video. This is Ankita, your commerce educator, welcoming you to Global Online UGC NET and SET exam preparation channel, where we are taking classes for NET and SET exam preparation. In today's lecture, we are going to cover price discrimination under different market form, perfect competition, monopolistic competition, oligopoly, price leadership model, monopoly, price discrimination, price strategy, price skimming, price penetration, and peak load pricing. This is the last concept under the business economics unit. Okay. We will cover the most accepted MCQ related to this topic. So do watch this lecture to clear your doubt about the same. And one more important thing, after watching this lecture, whether all the doubts are clear or not, how you are going to know this. So for this, Global Online brought you test analysis series. Now how you are going to get this? For this, you have to go on our app, that is on the Global Online, where you will get the test series which you can give there. Okay. And one more important thing, every day at 6 I will be uploading my video on our channel. So do visit our channel every day at 6 and clear your upcoming exam. Before going ahead, I want to tell you one more important thing. Students, Global Online is offering course for Commerce Paper 2 for exam 2022, in which we will be providing you full syllabus test series with the detailed explanation, full syllabus notes of all the 10 units, each and every concept we are providing detailed explanation. Then is full syllabus video lectures, that too with the detailed explanation, previous year MCQ with the detailed solution, previous year PDF with the detailed solution. We are providing this course just for rupees 5,000. At present, we are offering this course on offer, that is, we are providing you discount of 20%. If you are taking this course at present, then you will get this course for 20% discount. Okay. And if you are taking this course, the paper 1 we are giving you, that is free of cost, in which we will be providing you 50 mock tests with the detailed explanation, full syllabus video lectures with the detailed explanation. That too, we are also providing live lecture for paper 1. We are also giving you notes on all the 10 units, and you will be immediately added in the WhatsApp group. And if you have any problem regarding the syllabus, commerce as well as the paper 1, you can discuss that problem in the group. You can directly contact to the educators. Okay. To join this course, contact on this number and also download our app Global Online. There might be a question in your mind how to download our app. तो आपको प्ले स्टोर में जाना है एंड जस्ट टाइप ग्लोबल ऑनलाइन. फिर आपको कुछ ऐसा लोगो दिखेगा और उस पर आपको क्लिक करना है और आपको ये जो ऐप है वो अपने मोबाइल में इंस्टॉल करना है. ओके. इंस्टॉल करने के बाद अगर आप उसके अंदर जाते हो तो आपको कुछ ऐसा व्यू दिखेगा जहां पर आपको कॉमर्स पेपर 2 सर्च करना है और उसमें जाना है और उसके जो कॉमर्स के सारे जो स्टडी मटेरियल है, कुछ वीडियोस है, प्रैक्टिस MCQ है, वो आपको वहां पर मिल जाएंगे. हम आपको ये कोर्स ऑफर में भी प्रोवाइड कर रहे हैं, कुछ डिस्काउंट भी प्रोवाइड कर रहे हैं. ये डिस्काउंट आपको वहां पर जाकर ही पता चल जाएगा. तो प्लीज डाउनलोड अवर ऐप टू नो ऑल अबाउट दिस. और अगर आपको कोई भी डिफिकल्टी है तो यू कैन डायरेक्टली कॉन्टेक्ट टू द गिवन नंबर, और एल्स यू कैन ऑल्सो डाउनलोड दिस ऐप थ्रू द link which we are providing in the description box. Okay. When a market is in equilibrium, मतलब जब एक बाजार संतुलन में होता है, and the options given are no shortage exists. Second option is quantity demanded equal quantity supplied. Third option is a price is established that clears the market, and last option is all of the above are correct. A market equilibrium if at the market price the quantity demanded is equal to the quantity supplied. The price at which the quantity demanded is equal to the quantity supplied is called equilibrium price or a market clearing price, and corresponding quantity is the equilibrium quantity. That means the answer for this question will be option number D, that is all of the above are correct. That is no shortage exists, quantity demanded equals quantity supplied, and a price is established that clears the market. The next question here is a market structure in which many firms sell the product that are similar but not identical is known as. In a given question, they ask you the firms are selling the similar product but not the identical one. In which of the market structure? And the options given are monopolistic competition. Now what is monopolistic competition? Monopolistic competition is a type of a imperfect competition such that there is a many producer competing against each other but selling the product that are differentiated from one another and hence the no perfect substitute. Second option here is monopoly. In a monopoly, there is only one seller and number of a buyer. And the seller who is selling the product is a price maker and not the price taker. Third option is perfect competition. In a perfect competition, there are number of a seller and number of buyers. Okay. And last option is oligopoly. Oligopoly refers to the small number of a producer working either explicitly or to restrict the output and fix the prices in order to achieve above a normal market returns. A market structure in which many firms sell the product that are similar but not identical is known as monopolistic competition. Monopolistic competition characterizes an industry in which many firms offer the product or services that are similar but not perfect substitute. Barriers to the entry and exit in the monopolistic competitive industry are low and decisions of any firm do not directly affect those of the competitor. The answer for this question will be option number A, that is monopolistic competition. But please understand each option because you may receive the question on these options. The next question here is under which market structure average revenue of the firm is equal to the marginal revenue, and the options given are oligopoly, second option is monopoly, third option is perfect competition, and last option is monopolistic competition. In my previous question, I have explained you all the options, right? So, under the perfect competition market structure, the average revenue of the firm is equal to its marginal revenue. For a perfectly competitive firm, average revenue is not only equal to the price, but more importantly, it is equal to the marginal revenue of which are a constant. So here the answer for this question is option number C, that is perfect competition or Sahi Pratyogita. The next question here is in economy, what a consumer is ready to pay minus what the actually pays is termed as. मतलब अर्थशास्त्र में एक उपभोक्ता जो भुगतान करने के लिए तैयार है वह वास्तव में वह क्या भुगतान करता है उसे कहा जाता है and the options given are consumer equilibrium. Now what is consumer equilibrium? That we will understand first. Consumer equilibrium means the state of maximum satisfaction, a situation where a consumer spends his given income purchasing one or a more commodity so that get the maximum satisfaction and has no urge to change this level of a consumption given the price of a commodity is known as a consumer equilibrium. So this is the meaning of a consumer equilibrium. The second option here is consumer surplus. Consumer surplus is also known as a social surplus or a consumer surplus in the economy. The difference between the price of a consumer pay for an item and the price he would be willing to pay rather than without it. The third option here is consumer expenditure. Consumer spending is a total money spent on a financial goods and services by an individual and the household for a personal use and enjoyment in an economy. And the last option is none of the above. So here I have explained you all three options, and this must be now clear in your mind, right? So in economy, what a consumer is ready to pay minus what he actually pay is termed as consumer surplus. Okay, that means the answer for this question is option number B. Consumer surplus is defined as a difference between the consumer willingness to pay for a commodity and the actual price paid by them, or the equilibrium price. The next question here is, in a perfect competition, the firm what above ABC as the identical shape of the firm supply curve, and the options given are marginal revenue curve. Marginal revenue curve is a horizontal line that the market price implying perfectly elastic demand and equal to the demand curve. Under monopoly, one firm is a sole seller in the market with a differentiated product. Second option here is marginal cost curve. Marginal cost curve is defined as a change in the total cost divided by the change in the energy output. Under perfect competitive market, the MC curve is the same as the firm supply curve. Third option is average cost curve. The average total cost curve is typically U shape. Okay, please remember this. The average total cost curve is U shape. The average variable cost, that is AVC, is calculated by dividing the variable cost by the quantity produced. In perfect competition, the firm's marginal cost curve above the AVC has a identical shape of the firm's supply curve. Under perfect competition, average revenue is equal to the marginal revenue, so the firm will produce up to the point where the marginal revenue and the marginal cost are equal. So the answer for this question will be option number B, that is marginal cost curve. The next question here is, price discrimination is not possible in case of. In a given question they ask you, price discrimination is not possible in which of the following market structure, and the options given are perfect competition. Perfect competition means there are a number of a buyer and number of the seller. Then is monopoly, where there is one seller and number of a buyers. Third option is monopolistic competition, is a type of a imperfect competition such that there are many producers competing against each other but selling the product that are differentiated from one another and hence are a not perfect substitute. Last option is oligopoly. Oligopoly refer to the small number of a producer working either the explicitity to restrict the output or fix the price in order to achieve the above normal market returns. Here the answer for this question will be option number A, that is perfect competition. Price discrimination is not possible under perfect competition even if the two markets will be kept separate. Since the market demand in each market is perfectly elastic, every seller will try to sell in the market in which will get the highest price. Competition will make the price equal in both the market. However, price discrimination is possible and profitable only if the markets are imperfect. The next question here is, the degree of a monopoly power is a measure in terms of a difference between, and the options given are marginal cost and price. Second option is marginal cost and average revenue. Third option is marginal cost and average cost, and last option is marginal revenue and average cost. The degree of a monopoly power is a measure in terms of a difference between marginal cost and the price. In a perfect competitive market, price equals the marginal cost and a firm earn an economic profit of a zero. In monopoly, the price is set above the marginal cost and a firm earn the positive economic profit. So the answer here for this question will be option number A, that is marginal cost and the price. The next question here is, discriminating monopoly is possible if two markets have, and the options given are raising cost curve, Second option is raising and declining cost curve. Third option is different elasticity of demand, and last option is equal elasticity of demand. Discriminating monopoly is possible if a two market have a different elasticity of the market. Price discrimination is possible only when the buyer from a different sub-market are willing to purchase the same product at a different price. If the elasticity of a demand is the same, then the effect of a price change on the buyer will be identical too. The answer here for this question will be option number C, that is different elasticity of demand. The next question here is, in a long run, all the firm in the monopolistic competition, and the options given are earn supernormal profit, earn normal profit, incur losses, may earn the normal profit, supernormal profit, or incur losses. Now you know the what is monopolistic competition, which I have explained you in my previous question, right? So now what is supernormal profit? Supernormal profit is the amount of the profit that exceeds the normal profit. Normal profit is the amount of the profit intended to include the production. Economists consider the normal profit to be the cost of the production because of its necessity. Again, if we see the different meaning of the normal profit occur when the economic profit is a zero, or when the total revenue of the company equal to the sum of the implicit cost and the explicit cost. Is it a point where the business utilize all the available resources efficiently and the compensation is higher than the opportunity cost lost to the produce the product. Incur losses. Losses incurred refer to the benefit paid to the policyholder during the current year plus the changes to the loss reserved from the previous year. The answer here for this question will be option number B. In the long run, all firms in monopolistic competition earn normal profit. In the long run, the competition brought about by an entry of a new firm will cause each firm in the monopolistically competitive market to earn the normal profit, just like a perfectly competitive firm. During my previous lecture, I asked you one question. The question was, which is not a cost of a shift in a cost curve of the firm? And the options given was excess tax. Second option is price of inputs. Third option is increase in productivity. And last option is price of the product. So the answer for this question will be option number D. That is price of the product. The price of the product is not a cost of a shift in the cost curve of the firm. Cost curve shift in the response to the change in the two factor. If a technical change result in the firm using the more capital, the average fixed cost curve shift towards and at a low level of the output. The average total cost curve may shift upward. Here is the last question of today's lecture and you have to answer this question. The question is, in a perfectly competitive market, पूरी तरह से प्रतिस्पर्धी बाजार में, and options given are firm is a price giver and industry the price taker. Second option is firm is price taker and the industry is price giver. Third option is both are price taker, and last option is none of the above. Please answer this question. I am waiting for your answer. Write your answer in the comment box. Okay. Till then, keep watching, keep learning.